Formally, welcome everybody. So glad you're able to join us for HdL's latest California Sales Tax Trends and Forecast webinar. Before we get started, just to let everyone know, the presentation will be recorded and available alongside the slide deck on our website, hdlcompanies.com, very soon. All registered participants will receive an email once it gets posted. And as you heard me just mention, if you go ahead and open up the conversation icon at the top right of your screen, we'll be using the chat feature to answer any questions you may have. We'll have a Q&A session at the end of the presentation, so feel free to drop the questions in there, and we'll be happy to address them later on. By way of formal introduction, I'm Bobby Young, Director of Client Services here at HdL Sales Tax, and I'm joined today along with Bret Plumlee. We both work on the sales tax team and obviously enjoy meeting with clients and going through the sales tax analysis with you, all the revenue that comes into your local agencies, and especially at this vital time where we've really walked through the pandemic, been able to navigate it, but as we come out, what's to come? It's going to be very important, and we're really looking forward to meeting with all of you guys this next quarter, especially. Just a reminder for anybody that may not be as familiar with HdL, or if you know us already, we are proud to have been serving local communities for over 37 years. We are 100% employee-owned, which we take a lot of pride in keeping it amongst the employees as far as the business goes. We really try to focus heavily on superior service that allows us to increase the revenues for our clients, your local communities, while efficiently decreasing costs and making it as efficient overall as possible. We are thankful to have over 500 clients that we serve right now, and we are blessed to have a 99% overall client retention rate, which we value so heavily and appreciate you as clients. So let's go ahead and jump right in. I'm not going to waste any time overall. We do have the third quarter 2021 statewide results here. You'll see at the very bottom here, overall positive 18%. This is phenomenal news for the third quarter. It's the calendar year third quarter, July, August, and September time period, end of the summer months. The economy was roaring along, stock market going up, and we saw all these expected results, positive results that we had been forecasting. And in fact, there's going to be a couple of categories that exceeded our expectations. We had forecasted about a 15.5% positive increase or growth over last year for the third quarter, and what we saw was 18%. And specifically here, I'll point out, there's three categories as we go through our meetings with you this quarter that we're really going to be focused on pretty heavily. Autos, transportation, right at the very top, positive 16%. It's been phenomenal to see consumers overall and their interest in autos. Bret's going to be talking about that more specifically here in the webinar. As you look down a little bit, you'll see fuel and service stations at 54% increase. We also felt more people back on the road, increased gas prices, helping the results there. And then really the one that's caught us by surprise, so welcomed for many of our communities and even us as consumers to be able to go and dine out. We saw restaurants and hotels with a phenomenal 48% recovery. This was a category that had been expecting a very long recovery timeline. So we saw some good results this quarter and very welcome overall. The other thing that we've been doing is focusing on different regions here in California. And there are some regions that were not as heavily impacted by the pandemic, and certainly those that were much more so. What we saw this quarter was very, very balanced. So welcome overall, whether it's Southern California, the Bay Area at about 15%, inland with both the San Joaquin and Sacramento regions here, all the way out to the Sierra, as you can see. great results statewide. Again, so very welcome, and a continuation of what we had been seeing through as the reopening and the reemergence of consumers back into the marketplace, and especially brick and mortar locations. So breaking that down a little bit, again, solid here, right in the middle of the screen at the very top is where you'll see third quarter 2021, positive 18%. The complexities within this this slide are really to give some perspective historically where we've been coming from on a percentage basis. So you'll see really the depths of the pandemic, just kind of reminding 2Q20 down almost 16% statewide. This is when everything was closed. A lot of us were sheltered in place, buying things mainly online. And come third quarter, fourth quarter, we saw what ended up being very welcome response as we just saw flat results. Then as we turn the calendar page back at the beginning of 2021, we started to see the positive gains and recovery. And so that has continued here in the third quarter. Then as we look here to just past, these are our forecasted quarters that we have coming up. And I think it really starts to tell the story of what we've been reading, intaking, and then trying to apply back to sales tax, is we are anticipating a very solid fourth quarter period. So that would be the October, November, December time period we just lived through, holiday sales otherwise, even though you'll hear us talk throughout some supply chain issues, overall consumers, increase in prices. We are still anticipating on many fronts to see positive results. And again, you'll hear that through the webinar, but about almost a 15% forecasted for 4Q21. And then as we turn the calendar is where you'll start to see us be a little bit more cautiously optimistic about the future. Obviously, there's some headwinds. We'll touch on those again at the very end of what we're forecasting. But overall, for what many of you are looking at for fiscal year 21-22, right in front of us, or right in the middle, these first two quarters may end up just solidifying the overall results for the fiscal year, where even 1Q, 2Q might start to really slow down and pull back a little bit compared to recent activity. But these first two quarters are really probably going to set the tone for the overall fiscal year. The line below here is just to give us a historical frame of reference where we were before the pandemic and how we trunched through that and the depths that we had, and now where we are, where we're at, and where we believe we're heading. And as you can see, these out quarters getting a little bit more flat. And I think we could all kind of feel comfortable in that area. So that was the statewide overall, everything included. Here really focused on local place of sale, and when we're thinking local place of sale, think brick and mortar stores on the general consumer side, think restaurants, gas stations, those types of things that really took a hit through the pandemic. And I've kind of highlighted it over here on the red for local place of sale, how much they decreased, and even that part of it continued. Statewide, we saw results that were fairly flat. It had a lot to do with pools. Think online sales activity that we've spoken so much about helping the state. But now here really focused on the calendar year 2021, and you can see all of the positive results that we've been experiencing and what we're forecasting for the fourth quarter 2021 period. So again, hopefully this just gives some frames of reference or some perspective and how we break down and look at different pieces of the sales tax revenue. And I turn it over to Brett, and he'll be talking about a couple of categories, more specifically autos, building, and I believe fuel. So Brett.
Thank you, Bobby. We're going to start, as Bobby mentioned, we're going to go through all the major industry groups, starting with autos and transportation. And here is what is happening in the third quarter of 21 with autos and transportation, this particular sector. The story is volume is down while sales tax is up. The national prices continue to grow to record levels. New car prices are up 10% and used car prices are up 26%. We've been talking about this throughout the pandemic. They actually set record levels in terms of increases in the middle of the pandemic last year and are continuing to grow. We are seeing continued strong demand for luxury purchases. And we've talked about for some time now, past quarters, that supply has been constrained, especially with the chip shortages, but it now appears to be slowing in terms of the data that we've analyzed, at least in the first month of fourth quarter 21. It's going to take some time to get back to normal levels, and we may never see the previous levels of inventory. Dealers are now shifting, or at least potentially shifting, their business model to allow consumers to pre-order the vehicle and pick it up at a later date. So that's going to likely allow less need for inventory on the lots. So we'll go to the next one. And in terms of national auto sales, what we can see here in the chart, the volumes were fairly constant until the pandemic hit in that first quarter back in 2020. And then they dropped dramatically. That was then followed by a quick recovery, and the volume started picking back up. And then the industry experienced shortages in terms of that supply of chips, and that coincided with demand that was slowing as well. And that pushed the volumes back down in the middle of 2021. But why are these headwinds not being reflected in our sales tax data? The real story is in the prices. And nationally, prices have increased more than 17% in the third quarter and look to remain high for some period of time. From this data, the prices are increasing very significantly, and that is having much more of an impact than the decline in the consumption. Keep in mind that while the prices are high, the dealer incentives are pretty much non-existent at this point in time. The dealers just don't have to budge or negotiate on prices, and that goes for both new motor vehicles and used motor vehicles. They can sell it at whatever price they are listing at this point in time. In terms of overall growth, we had projected pretty flat in this quarter, 2% growth, and the actual results were much better than anticipated at 15.6%. And that mostly is due to the price increase that I'm talking about here. When you look at this particular sector, the autos and transportation, auto sales and leases make up 78% of the total. And the tax receipts have trended similar pre-pandemic levels, fairly flat. Supply constraints are now being overshadowed by these dramatic price increases and continued strong demand for inventory that's available. We are expecting the tax receipts to remain elevated while supply chain issues and demands keep prices high all the way through 2020. We're forecasting 7.7%. Bobby had talked about fiscal year 21-22. That's the fiscal year that you're most interested about right now as you're preparing your mid-year reviews. And autos and transportation, 7.7% growth for 21-22, and then a gradual slower growth rate after that, projecting long-term growth to flatten out closer to pre-pandemic levels at 3% annual growth all the way out to fiscal year 26-27. Now, building and construction, this particular sector has continued to do well. We talked about it during the pandemic. It actually recovered much more quickly than all of the other industry groups, that along with food and drugs, which I'll talk about in a moment. And the projection was 15% increase in this quarter. It finished a little bit lower than that at 8.2%. And that's mainly attributable to lumber prices slumped pretty significantly the first 2 months of this particular quarter, third quarter 21. And then they shot up again in September, mainly due to commodity availability issues. And following the second quarter sharp rise that we have been talking about in terms of permit values, the third quarter reported a flattening out, a significant drop. But when we look year to year, we're still seeing comparable to third quarter of 20 in terms of flattening overall permit values. Housing starts have been postponed until material prices drop substantially. And when that happens, the volume is going to then start to increase, and that will replace the high prices of homes. Interesting observation that we're seeing is office space development is starting to grow again, and that's been a surprise since during the pandemic there was a halt in the demand for this particular space. So overall, what we're projecting in forecast for 21-22 is 5.4% growth, and then back to closer to pre-pandemic levels, 5% growth annually all the way out to fiscal year 26-27. Food and drugs, I mentioned this is another sector that has been very stable, and that sector includes grocery stores and drug stores and cannabis related businesses. All have done really well during the pandemic, very steady growth. We projected 2% growth in this quarter, and the actual results were fairly flat at just under 1%, 0.8% for the quarter. Cannabis receipts have now plateaued at the rate of $12 to $14 million a quarter, and that's really after years of substantial growth. So we are projecting continued ongoing steady growth in this sector, starting to slow because more people, as Bobby mentioned, are eating out again. They want to be out at sit-down restaurants, and that's having an impact on grocery stores, which we're starting to see flattening out and dropping. And so 2% annual growth is continuing to be projected all the way out to fiscal year 26-27 for this sector. Now, fuel and service stations. This, as we anticipated, we had another really solid quarter. Bobby talked about good news really all throughout the economy and all the major industry groups that we're talking about today. And this is one of the ones that he highlighted at the beginning of his presentation. But we had almost 75% growth in the second quarter, and that was followed by 54% in this quarter, which was better than our actual projection of 40%. All signs in the sector are pointing to upward pressure on the sales tax received. The demand for fuel is much higher than it was a year ago. The average price of a gallon of gas has now exceeded the record level that was set back in October 2012 at $4.75 a gallon, which is pretty incredible, and really it's continuing to ratchet up a little bit since that $4.75. Diesel and jet fuel prices and airline travel are all up, and more people are hitting the road in terms of going to the office, shopping, taking their kids to school, taking vacations, and you see that in increased congestion, really back to pre-pandemic levels on the road at this point. All factors are pointing to upward pressure in the next three quarters as well. So fourth quarter 21, Bobby said we're going to have a really positive quarter, very likely because we're comparing to fourth quarter 20, and the economy is continuing to go full steam ahead. So we have 50% projected growth in fourth quarter 21, followed by 20% and 7% in the first two quarters of 22 in this particular sector, and long-term increases back to pre-pandemic levels of approximately 2% annually, all the way out to fiscal year 26-27. And then the other industry group that Bobby highlighted at the beginning, restaurants and hotels, we expected really positive performance, and that's what we realized. That's what we saw statewide. Actual results, 47.6%, a little bit better than our projection of 42%. And what we're seeing is continued pent-up demand for restaurants and leisure activity. The casual and quick service business types included in this sector have recovered, and those are the two biggest categories statewide. So that is good news, definitely, for the overall industry. We're expecting fine dining and entertainment to post strong recovery for the next 4 quarters. We're continuing to see very high spending consumer capacity, and people are out there and continue to have discretionary income, and they want to be out shopping and going to the restaurants, and there are fewer capacity constraints compared to 1 year ago. Another factor here in the sector, we are seeing it, you're experiencing it, rising menu prices, both at fast food restaurants and sit-down restaurants. Also, labor shortages have caused employers to increase the pay to try to attract workers. It's been very difficult to fill workers, especially in the fast food restaurants. 68% of the restaurants have reduced their hours due to lack of staff. So the demand is out there, but the restaurant owners are really having difficulty filling that demand. There's been an uptick in business travel, and the airline industry strongly believes that business travel will fully recover by 2024. The statewide results in this sector in the third quarter 21 are actually now 0.5% higher than the pre-pandemic third quarter of 19. So we're fully recovered in terms of this industry group and continuing to grow. Overall, fiscal year 21-22, we're projecting 32.9% growth in the entire fiscal year, and that's followed by a gradual slowing of growth back to the pre-pandemic levels, 3% annual growth starting fiscal year 23-24 all the way through 26-27. And with that, I hand it back over to Bobby.
Great. Thank you, Brett. Appreciate that. So we're going to jump into a couple of the bigger categories that especially the sensitive categories that we've been talking about most recently through the pandemic. But just a reminder at this point in the webinar, when we meet with you guys and we prepare forecasts for our clients, it's while we use a lot of what we look at statewide and the trends that are going on, we customize our forecast for you specifically. We bring it back to your businesses, how your businesses are performing, maybe consistent with the statewide, or maybe a little bit different, better or worse, and then we will hone in that forecast for your community and what we're seeing locally. As you heard Brett talk about auto dealerships and even restaurants, and we've seen phenomenal results statewide, it may actually come down to inventory locally or the availability of both indoor-outdoor dining on the restaurant front. So just a couple of reminders there, and it'll continue as we talk about general consumer goods or even the pools throughout. When we put together your forecast, we really do customize it to make sure that we're getting as close to possible for your community as we can. So let's jump in now into general consumer goods and what has been moving the category. You can see this is a line specifically related to discount department stores. Think big box retailers, Costco, Walmart, Sam's Club, Target, all the like here within discount department stores. And the trend overall, it'll always peak at the fourth quarter, and that's kind of what we're expecting in the next set of data we'll get is the normal holiday shopping period. You can see fourth quarter 2020, just last year as a result of the start and reopening from the pandemic period and what we've been experiencing more recently here lately, and what we're anticipating at a discount department stores is to continue to go up. Some of the larger big box retailers do also include fuel sales with their in-store purchase orders, their in-store sales tax. And so that also helps move the category along, as you heard Brett talk about how much gas prices have gone up most recently. So we are anticipating discount department stores to be doing really, really well. Those that were hit the hardest out of general consumer goods, this is a big category, so we're going to break it down just a little bit. You can see the depths of the pandemic, most notably for the apparel companies. But what I want you to kind of look at, much like restaurants, as we saw, is the rebound and where we've come to most recently. And then what we're expecting, almost a full recovery for many of the categories. Let's see, blue here is department stores. Online, the lose out to family apparel stores and discount department stores. Department stores, traditional department stores, may take a longer timeline to recover or just kind of flatten into their new normal. But pretty much everything else is expected to continue to rebound and recover from the pandemic period here on the apparel side. This category, kind of cheekishly proclaimed eagle, has been the specific businesses that have done really, really well, and probably of no surprise to many. But as you can see, jewelry stores, most recently, sporting goods stores, as the pandemic and the shutdown happened, everybody was getting out. That's the green line right up top here. You can see how much they've jumped up and maintained. And then also variety stores, lower cost as price-minded consumers really kind of found another way or another place to buy goods. These categories most recently have done really, really well. We attribute the jewelry stores, while it dropped off, and think mall locations that were closed during the pandemic. You could see that depth here. The gains out of the stock market, and I think I apply this also more generally. The growth and the gains that we've seen out of the stock market have given folks the ability to invest in other places as well. And this goes in line with jewelry, whether it be diamond or gold. It appears as though consumers are really pushing to invest and have make purchases and have an opportunity to buy goods that maybe they couldn't buy before. The overall increase in flood of federal money and availability of funds, really much like autos, have allowed consumers to kind of tweak and jump into things maybe they couldn't afford. So this has been pretty fascinating to watch because it may have a shorter run. You can kind of see our long-term forecast here for jewelry. It'll always kick up in the fourth quarter, but it may end up peeling off just a little bit from the place where we've been. Then the stores that usually also kind of hold the line, whether it be electronic appliance stores, home furnishing, or specialty stores, make up, and some of the other more specific retailers, we dump into the specialty stores. You can see, obviously, they also took a hit during the pandemic and have since recovered. Really on the electronic appliance stores, and that's the green line that you may see here, hasn't yet recovered. And a couple of large retailers, as you can imagine, whether they're mall locations, just aren't quite back to where they were, or consumers have found another way in which to buy the goods, may end up impacting them and not quite recovering to the levels that we've seen in the past. So again, we're kind of cautious with some of these. We're watching them very closely. Home furnishings, being the yellow line here, has taken a nice rebound, especially with the increased property values, especially home values, for consumers to feel like, hey, maybe it's time to reinvest it back into our property, buy some new furniture. And we've seen the yellow line recover, but how long leaves us just a little bit of question marks there. So overall, for the general consumer good category, again, it's so big and broad, and wanted to break it down a little bit. You see great results, 22% increase here in 3Q21. Still anticipating strong fourth quarter overall holiday shopping period. 1Q and this 8%, really for us, we're looking back at the 1Q21 period and realizing maybe there's still a little bit of growth to happen there, but you can see pretty quickly once we hit the summer months for general consumer goods, we're going back to more kind of the historical normal growth, which is a term I've probably been using a little over too much here in the office, but just going back to kind of some uptick in inflationary prices. Maybe consumers get a little bit cost conscious, not feeling like they're going to spend like they did or have most recently. So we do anticipate general consumer goods growth to slow down. Here's a line graph just to kind of reiterate what we've been talking about the last couple of quarters, as we've seen a reporting change and a reporting shift away for a couple of major online retailers, away from the countywide use tax pools, which is the green line here, and reporting to local jurisdictions where they have the fulfillment centers. And so there we see an increase or an uptick on the light green line, which is business and industry. And within that major industry group is where we'll show fulfillment centers. So I've got a slide here in a couple bit to reiterate that. But from the pandemic periods, and that's really the second quarter through the fourth quarter 2020, you could see how much online spending had increased. And there was probably really no way that we expected that to continue at that level. And you can definitely see here throughout the calendar year 2021, we've seen it tail off from where it was, but still remain rather strong. So kind of twofold there. And forgot that we had this, but from third quarter 2020 on average to third quarter 2021, only a 2% growth out of the pools. Again, no way we could really keep up that pace. But because of that reporting shift, we had seen business and industry jump up 18%. And then some of the trends overall, obviously, as we've talked a lot about the return of consumers back into stores now that that's available, is probably not unexpected. Would be a decrease overall for the pool, in terms of growth for the pools and fulfillment centers. Really think online retailers here, but an uptick for brick and mortar stores. For many of you, you can also appreciate that this is a welcome response, welcome recovery, where your local brick and mortar stores, you're getting the full 1% Bradley Burns rate versus just a percentage of the pool. In many cases, it's a much less, somewhere between 5 and 10% of that 1% versus the full 1% value. So this just kind of restates that and kind of what our expectations are with consumers coming back in brick and mortar. So first off, let's start with business and industry, because we've seen that dramatic growth, this gray period going back to fourth quarter 2019, all the way up through the pandemic. You could see most recently, we're almost there. So 3 quarters in to the reporting change that started back in 1Q21. And I don't know if we'll see it. You do see it here on the percentages. 23% gain on the business and industry side had a lot to do with the change for and new reporting to fulfillment centers. So we've seen a consistent dramatic gain. We are anticipating once the initial fourth quarter period is done, future gains will start to level off back to their normal historical growth again. Throwing that back in there. So not too much more to go when it comes to business and industry, and our future outlook is definitely leveling off. Here, more specifically on fulfillment centers, even through the first growth that you see here, starting in fourth quarter 2019, we've got a couple of notes over here to the right. Just a reminder, we had AB 147 and new tax revenue that began in fourth quarter 2019. We then had the pandemic that helped both second quarter, third quarter, and fourth quarter dramatically grow for those that reported locally. And then here starting in 1Q21 to now 3Q21 as the shifts in reporting that we've seen really jump up the gains overall for fulfillment centers specifically. Business and industry overall also is a very large category, a lot of different pieces to this puzzle. As you can see, this is just a quick line graph of some of the other categories here. Medical, biotech, as you can imagine, with the pandemic, really took off through 2020, has most certainly begun to level off as far as sales tax generated there. Light and heavy industrial businesses have remained, now post-pandemic, have remained fairly steady, and we do anticipate that trend to continue along. The seasonal effects of the light green line here, garden and agricultural, you can see really second quarter has set a tone, and even with here in earlier in 2021, with water shortages and others, garden agricultural suppliers actually had a nice second quarter, and this now being able to see that and frame it really tells us a little bit about what happened during those summer months. So just a couple others there. Won't highlight them too much. County pools now shifting away from business and industry in the fulfillment centers is goods really coming in from out of state or from online retailers that are out of state. This tax being allocated by way of the countywide use tax pool. You can see how much especially once we hit AB 147 and the new reporting requirement, how much they jumped up. But with the change back, or the change in reporting from the pools back to the fulfillment centers, you can see how dramatically now here in 2021 they've really, the growth has dropped considerably. This is a lead in for what we do anticipate out of the pools going forward. We will expect them to really not have as dramatic growth, with seeing more over there on the fulfillment center side. So just some notes as to just kind of reminders of where we've been when it comes to pools performance. Then also just a reminder of what makes up, and again, I won't talk too specifically because every county pool is a little bit different, but in general, the county pools are made up largely of general consumer goods, think online retailers here, of about 40%, with business and industry and kind of everything that's included there, whether it be medical, gardening, agricultural, electrical, all of those really kind of come into here on the business and industry side, 30+%. But again, every county is going to be a little bit different. Just a quick reminder here. So our forecast on the pools, as I kind of talked about the shift and this dramatic growth that we had seen previously, has most certainly tailed off in these most recent quarters, and we're anticipating that to continue through the end of this fiscal year at least, 5 to 6% growth. When we look outward and a more consistent 8 or 6% by quarter growth here, probably has more to do with the increased cost of goods or inflation as we think about it, really still driving up the taxable portion of the goods, or increasing the tax generated with the increase in the price. So pools should remain fairly steady, just not nearly the dramatic growth that we've seen previously. So bringing it all together now in the statewide trend and looking at it on a fiscal year basis, you can see how overall statewide, how we trended through the pandemic, really 1920 being the depths, with second quarter 2020 having such a dramatic impact, coming down to decrease 2%. Had a nice recovery in fiscal year 2021 of 11%. So second quarter 2021 already ended. We've seen now the start of the 21-22 fiscal year, and we're anticipating right now still seeing about 11% growth for the current fiscal year. Has a lot to do with the third quarter results that we just talked about, anticipating a very solid fourth quarter period to come. Overall, the economy hasn't really been hindered too much, and we can talk about some of the headwinds, and as you look outward of the fiscal year is kind of what we're seeing. The most recent variant, Omicron, while numbers are going up, we talk a lot internally. It does not appear as though some of the other factors or statistics like hospitalizations are nearly quite the same as what we experienced through the first COVID-19 pandemic. And that's giving us a lot of hope that while numbers may go up over the next maybe month or so, by the time we hit February, March, we probably won't continue to see the sales tax, or anticipate the sales tax impacts really hurting, really pulling back first quarter results to the levels that we saw previously. So with that, third quarter, fourth quarter should keep the current fiscal year really strong. I know a lot of the variants and some of the headwinds are first and foremost on people's minds, and that's kind of how we look at it. As we go out, though, you can see us returning back to more of a 3% growth right now. Not anticipating a very strong, like what we just experienced, periods, but also not expecting a dramatic drop-off or regular recessionary period. There's a few things that we believe have mitigated that to the benefit of the overall economy. And it feels like some of those headwinds are starting to be already factored in to everybody's expectations. And so just a few reminders as you go and some talking points, if you will, hopefully. Many of you will be doing a mid-year budget or financial update for your councils and communities. This is just a quick recap of all of the different packages, federal packages that help support our economy through the pandemic and even throughout calendar year 2021. The trillions of dollars they've pumped into the economy, and there's still a few out on the horizon that may end up supporting the economy. So believe that to still be more of a positive that we're waiting on to see. Obviously, the question is what'll happen once once people have to go back to work, have to pay their mortgages, pay their rent. It's not so much in our radar or at the front of our radar right now because we've seen such great results to date. Inflation, interest rates, Fed's starting to touch interest rates and increase interest rates to offset inflationary factors. We have seen the cost of goods go up, and what will happen with consumers considering the goods cost of goods have gone up. It is a major part for us as folks eventually go back into offices. If they have to pay more for gas, that's less money to be spent elsewhere. Yes, it's there. We're really watching and listening. Interest rate hikes. It appears as though multiple, but later in the calendar year 2022, which is actually the start of the fiscal year 22-23. So again, as we think about mid-year and what's in front of us for the current fiscal year, probably not as many impacts as the lasting. And it's really, I would say that's probably the majority of why we've started to level off those future growth expectations is the consideration of higher interest rates. What will it do for home values and consumers' confidence to continue spending at an increased rate? Here you can see again just what we anticipate, what fell off between both goods and services during the pandemic. And obviously goods have rebounded much stronger than services. We know that services are to come. And again, probably as we reach into 2022, folks getting back traveling again, spending on non-tangibles. We've seen Disneyland, Knott's Berry Farm, and other Southern California. I'm sure it's the same up in Northern California. Seeing amusement parks and other non-taxable goods or experiences start to increase, and that'll steal some of the money that would otherwise be spent on goods. So we know this is to come, and again, we feel like we've factored that into our forecast going out, that there'll still be some good amount of spending on goods, but it'll be mitigated compared to what we've just been experiencing. Online sales, we are always watching to see what the trends are here. Really on this line, the black line you see 2020 by quarter period. And the normal peak that we experienced, obviously, though, right there at the pandemic, that high point, no way that we expect to keep pace with that. And so we're watching to see what happens here in the fourth quarter, what just happened in the fourth quarter with online sales. We do anticipate a bump up from prior periods. Is it going to equal or exceed what happened a year ago, which could also, again, just really help support fiscal year 21-22 numbers. And then just another way that we look at data or just kind of bisect it through overall statewide, how we've been trending, and the normal fourth quarter holiday shopping period really boosted up there. So final takeaways as we get to towards the end here of the webinar. What we've seen overall, FY 2021 local tax revenue grew in excess of 10% statewide, nearly 8% above the pre-pandemic levels. So it was a great rebound there. Anticipate that the economy and spending appears to have remained strong through the fourth quarter 2021, which would be the middle of the 21-22 fiscal year. So we are still anticipating and forecasting about 11.5% growth for the current fiscal year. So the story remains strong, but it's really starting in 2022 calendar year, where price and inflation is becoming a bigger concern for consumers. Federal interest rates it being on the horizon, again, probably pushed out another full fiscal year there. But as Bret really talked about, and we know, even though the ports are being offloaded as quickly as possible, the whole overall supply chain could still be a concern for consumers and restrict some spending that might otherwise happen. So here at a short-term forecast, having more slower growth beginning 22, 23, and we'll kind of hold that line overall until we hear more about possibly, maybe a next recession or another factor that could thereby boost up our expectations for the future. So hopefully that is all helpful for you and your local communities as you start to put the pieces together for the current fiscal year and start your planning for next fiscal. And we do look forward to meeting with all of you as clients over the coming months to really walk through what we've customized for you. At this point in time, we'll go ahead and do the Q&A. So as a reminder, the conversation or the chat feature up in the top right on your screen will give you access to the questions that folks have asked. Bret, I don't know if there's any that you might have, I've been talking for a while. I don't know if there's anything that stood out to you.
We think we've published these, but the questions that I've tried to answer as we've gone along, we had a question about the pool calculation. How is it calculated, distributed? It's based on point of sale cash as a percentage of the total point of sale cash within your county, and that's done each quarter. So it's one quarter at a time. You always want to look at how well your cash is doing in comparison to the cash within the county. And then we had a couple of other questions here that we've answered. There's a question about the long-term forecast. When you look at the out years, why is there an increase in 24, 25, all the way through 26, 27, a little bit higher than fiscal year 23, 24? And I answered that based on, there's 3 industry groups that have a slightly higher projection in those out years: building and construction, restaurants and hotels, and food and service. We have slightly higher growth in those out years, those last 3 fiscal years, and that's what is attributable for that slight difference between 23, 24, and then all the way out. And Bobby mentioned, there's a number of factors that go into our overall statewide forecast. There is a question related to, along those lines, what are the projections for California population loss or growth? How does that impact sales tax projections? And that's more of a macro factor. We do definitely take into account significant long-term changes that we may be anticipating. I would say, and Bobby, you can weigh in on it too. I would say in terms of population growth, our forecast at this point is just really steady, ongoing, typical growth that we've seen in the past. We don't have any anomalies that we've factored into long-term in terms of the projections related to sales tax and population loss or growth.
Yeah, it's a tough one for us to always try to quantify as well. If even if we see population numbers decrease, but the cost of goods increase, as I think Bret may have just mentioned, is we're still going to see either the same or an increased amount of sales tax overall generated. So we haven't had experience with past analyzation of data to really say, oh, here's how sales tax ebbs and flows with population. Now, obviously, over the last 70 plus years here in California, we've only seen population increase. But I think most recently, the dynamics, I think there's other dynamics that play into that'll help offset any changes in population. One is, I don't believe that we're going to have a dramatic drop in our population overall. Locally, in certain communities, as businesses come and go, that may be the case. And again, we'll take your local sales tax projection, we'll customize it to include that dynamic. But we still live in a beautiful state with beautiful weather, especially during the winter months. If anybody got a chance to watch the Rose Parade, the San Gabriel Hills down here in Southern California were just showing off, kind of tempting everybody to come back to California. But what we've seen out of not just the increase in prices, but more especially, and we watch this very closely, the increase in the stock market and the effect that it has, especially on maybe our 1% communities, our very high-end earners, high-end spenders, pretty much throughout the state, they're all there, that the increases in the stock market actually have a more tangible effect than, say, population back on sales tax. And that's pretty fascinating for us to watch. So I would say there's the likelihood of mitigating factors with the question of a reduction or decrease in population overall. Let's see. Is there we had a question, more of a general question. Is there a link to the presentation or a PDF of the presentation? Yes. Once we get the actual webinar administered and on the website, we'll also be including all of the slides in a separate PDF document for you to access and review or ask us additional questions at that point. So those will all be made available to you later on. What is the projected CPI increase factored into the overall projection? So for us, again, CPI, while we include it into our thinking, it's not so one-to-one plugged in. We do analyze for the expected increase in cost of goods, but we also mitigate that with because CPI most recently got reported, and I believe it was 7 or 8%, somewhere around there. That okay, we can't just expect sales tax to go up by that amount. And so we do mitigate that a little bit, expecting that consumers will peel back a little bit if the cost of goods go up. And that, I think, is where you'll see us still have a positive outlook. And this question was asked earlier, seeing such positive expectations for even 22, 23, still 3.6% growth, is that cost of goods are going to go up. At some point, we anticipate that consumers will peel back a little bit as much as they buy. And I think that has a lot to do with this variant, or a little bit of more slowing in 22, 23, 24 is eventually that all catches up. But more specifically, we don't have CPI tied back into our sales tax amounts generated, because we do consider other things in that picture for the forecast. So hopefully that helps. I think that's the last question that we have there. Just coming up on the noon hour. If no more other questions, if something happens to come up where your brain's kind of triggered for, oh, I wanted to ask, the whole team is always available to you as a client. Feel free to reach out to us, email, reach out to our office numbers. I think we've got it. Let me go to the last slides here. Oh, we forgot to put it in for the last slides, but feel free. That we've also got on our website the ability to ask a sales tax question or reach out to somebody, and we'll respond to you there. But yes, feel free to let us know if you have questions that come up. Otherwise, as I made mention, we're looking forward to meeting with you over the next couple of months to walk through not just the 3Q results for your agency and your community, but also the forecast and what that looks like. And with that, Brett and I are so pleased to have you join us today. So thankful to be with you, and really look forward to seeing you soon. Stay healthy, and yeah, Happy New Year. So thank you guys so much. I really appreciate it.